This video's topic shines a light on an asset class that, while often overlooked due to its simplicity, plays a foundational role in the financial markets, namely cash. Let's explore why cash is so important in trading, its role as a numeraire, and the various factors that influence its value and liquidity. Furthermore, we will explain the basic concept behind currencies. Note that in finance, cash typically does not necessarily refer to physical cash that you hold in your wallet or under your mattress. Instead, it just represents money at your disposal, such as in your bank account. Cash is universally recognized as the most standardized and liquid asset. It serves as the intermediary in almost all transactions. If you're looking to trade one asset for another, you typically convert the first asset into cash and then use that cash to purchase the second asset. This process is efficient because cash is trusted by all parties involved. Further, cash is used as the universal accounting standard or numeraire for almost all transactions. The concept of numeraire is central in economics and finance. It's the standard by which all values are computed. In the world of trading and investment, cash often serves as this benchmark. So let's break down the value of cash into two perspectives. First of all, cash represents purchasing power. It's what you can exchange today for goods and services. If you have $100 today, you could buy resources, rent a house, or pay someone to do something for you. Note that here the emphasis is on today. It is vital to understand that cash today is not the same as cash in the future. Essentially, cash in hand today is worth more than the same amount promised in the future. This is the case because money that you have now can be invested to earn a return. To understand this better, let's consider a simple example. If you invest $100 at a 5% annual return, in 1 year you will have $105. That means normally cash now is more valuable than the same amount of cash in the future because the cash that you have now can be used to invest and earn a return for the future. A possible objection to this is that you might not want to take on any risk with your cash, so you can't actually earn this 5% return without taking on additional risk. However, there always exists less risky investment options, and at least in theory, there also exists an investment that returns the so-called risk-free rate without taking on any risk. In reality, this assumption of a complete lack of risk might not be the most realistic. However, oftentimes assets such as US Treasuries, which are essentially loans to the US government, are used as a proxy for the risk-free asset, since the chance that the US government defaults is oftentimes estimated near 0%. The exact annual rate varies over time, but is often around 5%. Also, note that the return you can generate depends on what time frame you're looking at. For instance, there might be a difference in how much risk-free return you can generate if you're willing to lock up your capital for 1 year compared to 5 or 10 years. That said, note that besides the loss of purchasing power stemming from losing the time value, in case you do not invest your cash, there also are other factors to consider when talking about cash. If factors change that influence the purchasing power or the risk-free rate, the value of your cash position changes as well in comparison to other assets. For example, inflation refers to the often seen decrease of purchasing power over time. Possible factors are policies that increase the supply of cash and thus lead to a decrease in the purchasing power of your cash over time. If interest rates rise, making use of your money by lending it to others gets more profitable, and the opportunity cost of having it lay around increases as well. Furthermore, your cash will likely be in a specific currency, and if that currency's value changes, your purchasing power in relation to people holding other currencies also changes. Finally, depending on how you store your cash, you also might be exposed to other risks, such as counterparty or storage risk. If, for instance, you hold all your cash in an independent, non-backed bank, you're vulnerable to that bank going under. Alternatively, if you store all your cash under your mattress, you're exposed to your house burning down, someone robbing you, rats eating your cash, and so on. Forex, or currency trading, is the exchanging of one currency for another. This happens through financial institutions and trading companies, but the root of currency trading is basic economic activity. Imagine, for example, you're an American and live and breathe dollars. Now you want to buy a new pickup truck from a European car manufacturer for 54,000 euros. You only have dollars and the car manufacturer wants to get euros. The exchange rate of USD to euros is currently 0.9, so you first go to a financial market and use your $60,000 to buy 54,000 euros. After this exchange, you can pay in the accepted currency. Note that in reality, this often happens automatically through your bank. Economic factors can significantly impact currency values, making forex trading highly dependent on international and national economic states. Unlike the poor exchange rates often seen at airport currency exchanges, the public forex market operates on very tight spreads due to the huge amount of currency transactions and liquidity. This is a consequence of international trade, for example showcasing the efficiency of open markets. Understanding cash's role in the financial ecosystem is crucial for anyone looking to navigate the markets effectively. The motivation for people using cash is usually that it serves as a numeraire, or universally accepted basic standard to compute and exchange the value of all other assets. Furthermore, it serves as a fundamental asset class that informs many aspects of trading and investment strategies. Some key considerations to remember about the value of cash are the risk-free rate, which is an important benchmark in finance representing the return of a 100% safe investment. Furthermore, you should be familiar with the time value of money, which is the principle that money available now is worth more than the money available in the future due to its potential earning capacity. So to summarize, just having access to resources such as cash already has an inherent value. In interviews, topics such as cash and currencies rarely get asked, but it is still important to understand the idea behind opportunity cost. Furthermore, in some brain teasers, you can evaluate the same concept from different perspectives. This is similar to the thought process you can have about currencies. By principle, it is just a unit like in physics, but the conversion rates of the units can change and it is important to stay consistent in your perspective.